And we head to the global space now with Laddie Williams. Laddie?
Yeah, good morning, Eni. So much playing out in global space, and it's still rate setting, seizing, and moments for what to expect going forward when it comes to interest rates. And we see Federal Reserve Chair Jerome Powell. He said the central bank will keep borrowing costs elevated for now, pointing to a resilient labor market and inflation that remains above target, signaling patience before any more rate cuts. Let's bring in, Isaac Marshall now to bring us up to speed on what's played out, so far with the rate setting season. Hello, Isaac. Great to have you on the show.
Lottie, it's great to be connected with you again. How's it going?
It's going great, and definitely we know the central bankers, they're on the spot at this time and trying to calm nerves about what's to come when it comes to markets and the rallies we've seen lately. What are the key takeaways from Jerome Powell's comments yesterday?
I think people have been talking about valuations being high. It feels like at this point 15 years now, right? I think that people have been concerned that the valuations of the stock market, particularly the S&P 500, driven by the sort of incredible performance of the Mag 7, it has been quite high for quite some time. But I think that the biggest ratio to look at and the framework to understand it, there's a guy called Robert Shiller who does what are called cyclically adjusted price to earnings ratios. And if you do any kind of statistical analysis, the most correlated with long run returns in the US stock market is looking at this kind of metric. And very simply, it just looks at the current price of stocks divided by the average last 10 years of real, in other words, inflation adjusted earnings. And while, stock prices, price to earning ratios have continued to go up, when you look at as a metric of the last 10 years of earnings, actually, we're not really at the levels of the dot-com bubble. We're still south of where we've been at different points in history in the past. Again, that's not to say that the markets can't experience vol. I think there's a huge amount of geopolitical shocks that are in the system. But I think that the idea that markets are going to collapse simply because valuations are high, if anything, the fact that the Fed is keeping rates where there are is an understanding that despite the fact that there's a lot of cracks in the system, markets are performing well and things are priced strongly. So I think fundamentally the Fed chair's assessments are correct. From a market participant perspective, I don't think it signals that there's impending sell-off or anything like that.
But do you think what we're seeing with gold prices so far, gold hitting new highs, and the stock market's also rallying, is that anything to go by with what we're seeing with gold?
I think if you look at the bond market at the moment, and certainly if you look at gold, it looks like we're priced for a ton of geopolitical volatility. And I think that's sort of what you're seeing in the world at the moment. But at the same time, I think that there's two factors to consider here. One is that the median company in the world today continues to sort of perform quite strongly. I think you are seeing pressure on the consumer, particularly in the U.S., but also globally, where I think that there's more challenges with the consumer sector. I think you're seeing non-performing loans begin to creep up, and I think we could be over the next 12 to 24 months, I think, facing some economic volatility. But I think one of the things that folks don't talk about as much, but I think is important to consider, is that the average company today manages earnings so much more consistently, has improved margins so substantially, that really the only thing that's nerve-wracking to me is just the amount of leverage in the system. So I think the point is, I don't think valuations collapse just because gold is going up or because bond yields are volatile. You really need an event to actually dislocate, and until that happens, I think you'll see valuations hold where they are.
Fantastic. Well, we'll keep tracking all of those price movements, even with the safe haven metals there and with the risky assets. Thank you so much, Isaac Marshall, investor at TLG Capital. Thank you.
Lottie, take care, man. Thank you.
Take care. All right, let's circle back now. Let's hear what Fed Chair Jerome Powell had to say yesterday.
The U.S. economy is showing resilience in the midst of substantial changes in trade and immigration policies, as well as in fiscal, regulatory, and geopolitical arenas. These policies are still emerging, and their longer-term implications will take some time to be seen. Recent data show that the pace of economic growth has moderated. The unemployment rate is low but has edged up. Job gains have slowed, and the downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In recent months, it has become clear that the balance of risks has shifted, prompting us to move our policy stance closer to neutral at our FOMC meeting last week. GDP rose at a pace of about 1.5% in the first half of this year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. Activity in the housing sector remains weak, but business investment in equipment and intangibles has picked up from last year's pace, largely reflecting the AI build-out. As noted in the September Beige Book, which I bet you wonder what it is, the September Beige Book, that's a report that gathers qualitative information from across the Federal Reserve System. We'll talk about later. Businesses continue to say that uncertainty is weighing on their outlook. They have since moved up, but remain low relative to the start of the year. In the labor market, there has been a marked slowdown in both the supply of and the demand for workers, an unusual and challenging development. In this less dynamic and somewhat softer labor market, the downside risks to employment have risen. The unemployment rate edged up to 4.3% in August, but has remained relatively stable at a low level over the past year.